Most people in crypto are still watching candles on a chart, red, green, up, down. They believe the price tells the full story, but here is the truth most traders never learn. Price is always the last thing to move. The real story always happens first beneath the surface, inside the ledger, inside liquidity, inside supply. And right now, something extremely unusual is happening with XRP that very few people are paying attention to. While the retail crowd is distracted by short-term price action, over $1 billion worth of XRP has quietly disappeared from public exchanges. Not sold, not dumped, simply removed, pulled out of reach, locked away. This is not noise. This is not random. This is the kind of movement that usually happens right before a major shift in a market cycle. Welcome back to We Are Cosmic. This channel is not about hype. It is not about clickbait targets or emotional trading. Here, we break down what the data is actually saying, so you can think like institutions, not like panicked retail. If you care about understanding crypto at a deeper level, supply, demand, liquidity, and smart money behavior, then you are in the right place. Now, let me be very clear from the start. What we are seeing with XRP in early 2026 is not normal market behavior. Since the year began, more than 570 million XRP has been removed from exchanges and moved into private custody. This means fewer coins are available to buy, fewer coins are available to sell, and fewer coins are available for leverage, shorting, or panic dumping. When supply starts vanishing like this, markets change their rules. Normally, when an asset reaches a psychological level like $2, people take profits, coins flow back to exchanges, sellers appear, liquidity increases, but this time, the opposite is happening. Even at this price level, XRP is being withdrawn faster than it is being deposited. That alone should make you pause. Think about this carefully. If people believed $2 was the top, they would be rushing to sell. Instead, they are rushing to secure the asset. That tells us something very important about expectations. It suggests that many participants, especially large ones, believe the real value lies much higher. What makes this situation even more interesting is the disconnect between price and supply. XRP's price is holding steady, but exchange reserves are falling sharply. This divergence almost always signals pressure building under the surface. It is like compressing a spring. The longer it stays compressed, the more violent the release tends to be. This is not about one or two whales moving funds around. The scale is massive. We are talking about a $1 billion drain in less than 3 weeks. Data providers like Sentiment confirm that this is one of the largest exchange outflow events XRP has seen in years. When liquidity leaves the market this quickly, it changes everything. Volatility, price discovery, and risk. And here is the most important mindset shift you need to make. The people removing XRP from exchanges are not traders. Traders need liquidity. They need fast access. These buyers are behaving like long-term holders. They are not preparing to sell into a small pump. They are positioning for something much bigger. So make sure you stay with me until the end, because by the time we are done, you will understand why the current XRP price is not telling the real story, and why 2026 may be remembered as the year the market completely repriced this asset. To really understand what is happening with XRP right now, we need to zoom out and focus on one thing that truly controls price: liquidity. Liquidity is the amount of an asset that is easily available to buy or sell at any moment. Exchanges are where this liquidity lives. When coins leave exchanges, liquidity dries up. And when liquidity dries up, price behavior changes dramatically. Since the opening days of 2026, XRP exchange reserves have been falling at a speed that cannot be ignored. More than 570 million XRP has been withdrawn from centralized exchanges and moved into private wallets. This is not just one platform. This drain is happening across all major exchanges at the same time: Binance, Coinbase, Bybit, and others. When multiple venues show the same behavior, it signals a structural shift, not a temporary anomaly. Now, here is why this matters. Every XRP that sits on an exchange is part of the tradable supply. It can be sold instantly. It can be borrowed for short positions. It can be panic dumped during volatility. But the moment that XRP is moved into cold storage, it becomes inactive. It stops participating in daily price discovery. From the market's perspective, it almost stops existing. This is how a supply squeeze begins. Demand does not need to explode immediately. All that needs to happen is for supply to quietly disappear. That is exactly what the data is showing right now. Even though XRP's price is hovering around the $2 level, the amount available to trade is shrinking rapidly. This creates a dangerous imbalance for anyone betting on lower prices. Under normal conditions, price and supply move together. If price rises, supply increases because sellers step in. If price falls, supply tightens because sellers disappear. But in this case, price is flat while supply is collapsing. This is a rare divergence, and historically, it does not last long. Let's talk about the psychology behind this behavior. The people withdrawing XRP are not reacting emotionally. Emotional traders sell into strength or fear. These withdrawals show conviction. They show planning. They show a belief that holding XRP outside the exchange is more valuable than having it ready to sell. That belief alone tells us expectations are shifting upward. Another critical metric confirms this trend: outflows versus inflows. Right now, for every 1 XRP being deposited onto exchanges, roughly 4 XRP are being withdrawn. That is a 4-to-1 imbalance. This means sell-side liquidity is being removed faster than buy-side liquidity is being replenished. Over time, this creates thinner order books and larger price gaps. Thin order books are dangerous in both directions, but especially to the upside. When buy pressure increases even slightly, there are fewer sell orders available to absorb it. That is when price starts jumping instead of climbing. This is how markets go vertical, not because of hype, but because of math. What makes this situation even more serious is the speed of the drain. This is not happening over months. It is happening in weeks. The faster liquidity leaves, the less time the market has to adjust smoothly. Sudden adjustments tend to be violent. And this is where many retail traders make a mistake. They see a stable price and assume nothing is happening. In reality, stability during a liquidity drain is often the calm before the storm. Price stays flat, not because the market is weak, but because supply is being quietly absorbed without resistance. Another important point: this is not just about spot trading. When exchange reserves fall, it also affects derivatives markets. Shorts become more dangerous because borrowing supply becomes limited. Liquidations become more likely. This creates a feedback loop where price increases force shorts to cover, which pushes price even higher. So what we are seeing right now is the foundation of a supply shock. Not the explosion yet, but the setup. The market is being hollowed out from the inside. Liquidity is being removed, order books are thinning, and the risk profile is shifting. Usually in crypto markets, accumulation is one-sided. Either whales are buying while retail is selling, or retail is buying while smart money quietly exits. That transfer of wealth is how markets normally function. But what we are seeing with XRP in early 2026 is something far more unusual. Both ends of the market are accumulating at the same time. On one side, we have massive wallets holding 10 million XRP or more, steadily increasing their positions. These are not emotional buyers. These wallets belong to institutions, funds, corporate treasuries, and ultra-high net worth players. They move slowly, deliberately, and with long-term intent. When these wallets accumulate, they are not chasing a short-term pump. They are positioning for a structural shift. On the other side, we have smaller retail wallets, accounts holding less than 10,000 XRP, also increasing their balances. This is extremely important. It tells us that retail is not panic selling into whale demand. Instead, retail is holding and adding. That removes one of the biggest sources of liquidity that whales normally rely on to exit their positions. This is what we call a dual accumulation engine. When both whales and retail are buying together, the market loses its natural pressure release valve. There is no easy supply coming back onto exchanges. Everyone is aligned in the same direction, and that creates a supply vacuum. Think about what that means in practical terms. If whales want more XRP, they usually wait for retail fear. If retail wants cheaper prices, they usually wait for whale distribution. But right now, neither side is blinking. Both groups are acting with conviction. Both are removing XRP from exchanges. Both are locking it away. This synchronized behavior is one of the main reasons why the $2 price level has become so resilient. Every time price tries to dip, buyers absorb the supply almost instantly, not because of hype, but because the available inventory is thin. The market is not allowing price to fall easily because there is not enough supply willing to sell. Another powerful signal comes from wallet age data. The XRP being moved into private custody is not coming from old inactive wallets waking up, it is coming directly from active exchange balances. This means coins that were once liquid are becoming dormant. Once coins enter cold storage, they tend to stay there for a long time. This changes the behavior of the entire market cycle. In previous years, retail often served as exit liquidity for whales. In 2026, that relationship has flipped. Retail is no longer feeding the sell side. Retail is behaving more like long-term holders. That alone removes a huge amount of downward pressure from the market. Now, does this mean price can only go up? No. Markets never move in straight lines, but it does mean that pullbacks become harder, faster, and shorter. When everyone is holding, even bad news struggles to push price lower. Another key insight here is mindset. Retail behavior has changed. Instead of chasing pumps and panic selling dips, many retail holders are treating XRP as a strategic asset. That psychological shift is extremely important. Markets move not just on money, but on belief, and belief is clearly evolving. This also creates a problem for anyone hoping to buy much lower. When both whales and retail accumulate together, there is no obvious source of new supply. That is when markets reprice violently, not gradually. Price must move higher to convince holders to sell. There is no other mechanism. Now that we understand the dual accumulation happening between whales and retail, it's time to look at the institutional layer, which is where XRP's supply squeeze becomes truly structural. This is not speculation or retail hype. This is capital that moves slowly, deliberately, and with long-term intent. At the start of 2026, several large XRP spot ETFs and institutional-grade products began absorbing XRP at a record pace. According to public filings, over $1.3 billion in new capital entered these funds in just the first 3 weeks of January. This is not short-term trading capital. This is sticky money, capital that is legally and contractually committed to long-term holdings. Once these tokens are in ETFs or corporate vaults, they effectively vanish from the liquid market. Why does this matter? Because it amplifies the supply squeeze we discussed earlier. When retail and whales remove coins from exchanges, the remaining float is already limited. Now add institutional custody, and suddenly the coins available for trading or shorting shrink to historically low levels. Exchanges become thin, order books are fragile, and even a modest increase in demand can send prices sharply upward. This phenomenon also shifts the market psychology. Traders who have been watching XRP for years know that supply on exchanges is king. When the institutional layer removes large amounts of XRP, price stability is no longer guaranteed. The market is now front-running a supply shortage. Everyone knows there's less available, and buyers act faster because they fear missing out. Another effect of this institutional participation is the creation of a black hole for liquidity. When XRP enters ETFs or corporate balance sheets, it is no longer part of daily price discovery. It cannot be sold during a flash crash. It cannot be borrowed for short positions. In effect, it is permanently locked, and that reduces the market's ability to absorb volatility. This is a structural change, not a temporary trend. This is why the current price around $2 is misleading. From a casual perspective, it may look stable. From a supply-demand perspective, it is precarious. The exchanges are running low, retail and whale accumulation continues, and institutional custody has removed billions of dollars of XRP from circulation. This is exactly the setup for a rapid vertical price move. Let's also consider the strategic reasoning. Institutions aren't just buying XRP to speculate. Many banks and payment providers are integrating Ripple's infrastructure. XRP is increasingly being positioned as a primary settlement layer for cross-border payments. Every transaction they plan requires holding XRP to ensure liquidity. These aren't trades, they are operational necessities. The more XRP that is locked in for practical use, the more pressure builds on the remaining liquid supply. And it's not just about immediate demand. Institutional holders are planning years ahead. Their vaults and ETFs won't liquidate in response to short-term market fluctuations. That creates a long-term floor under the price because fewer coins can reach the market, even during a correction. It's a safety mechanism for the market's upper structure, reinforcing scarcity. Another indicator of permanence is the correlation between exchange outflows and ETF inflows. Every coin leaving an exchange is increasingly being absorbed by an institution. The math is straightforward. The gap between liquid supply and total demand is widening dramatically, creating a market where upward price moves are not only likely, but almost inevitable once external buying pressure increases. In short, Retail and whales set the stage, but institutions provide the structural steel. Without institutional involvement, supply squeezes can reverse if retail panics. With institutional custody, the drain becomes permanent. This is the difference between a short-term pump and a fundamentally repriced asset. Up until now, we've focused on exchange outflows, dual accumulation, and institutional custody. But there is another layer that truly shows why XRP's 2026 story is different from previous cycles: on-chain usage and settlement activity. This is where we see XRP shifting from a speculative asset to a real functional liquidity network. Historically, XRP's price moved primarily due to speculation. Traders bought hoping for short-term gains, and liquidity on exchanges dictated how high or low price could go. But now, the XRP ledger is showing record on-chain transaction volumes, even while exchange trading remains relatively flat. This is critical. It signals that XRP is being used for its intended purpose: fast, low-cost cross-border transactions and settlement between institutions. Every on-chain transaction creates natural demand. Unlike retail speculation, which can reverse instantly, operational demand is sticky. Banks, payment providers, and large corporations need XRP to move value efficiently. Each transaction requires holding XRP temporarily to ensure liquidity. That means every operational use contributes to structural scarcity, adding another layer to the ongoing supply squeeze. Let's consider the scale. With over 570 million XRP removed from exchanges and billions locked in institutional custody, the remaining coins on exchanges are already minimal. When you add active on-chain usage, these coins are temporarily locked during transactions, further reducing liquidity. It's like a flowing river being diverted into multiple reservoirs. Even though the water exists, it isn't available for trading. This dynamic amplifies the effect of the supply drain. Another factor is the timing and velocity of movements. On-chain settlements are increasing sharply right as retail and institutional accumulation continue. That convergence is rare. It's a perfect storm where coins are being withdrawn from exchanges, locked in custody, and simultaneously used operationally. All three forces are acting in sync to create a structural scarcity environment. This is also why traditional technical analysis can be misleading. Price charts often fail to account for coins that are temporarily or permanently unavailable for trading. Looking at XRP through a purely exchange-based lens may suggest stability. But when we factor in on-chain activity and institutional custody, the true available float is far lower than it appears. That is why even small buying pressure can trigger large upward moves. Psychologically, this also changes market behavior. Traders who monitor supply begin to realize that opportunities to buy at lower prices are shrinking. Scarcity creates urgency, and urgency amplifies demand. This is a self-reinforcing cycle where the market's perception of limited supply drives real buying activity, which then reinforces scarcity further. It's also worth noting that this structural scarcity is different from speculative hype. This isn't retail FOMO pushing price up temporarily. This is functional, operational, and strategic demand supported by long-term accumulation. When price eventually reacts, it does so not because of rumors or social media sentiment, but because the underlying market mechanics leave no other alternative. Now that we've analyzed exchange outflows, dual accumulation, institutional custody, and on-chain activity, it's time to connect all the dots. This is where the hidden XRP story of 2026 becomes crystal clear. We are looking at a full-scale supply squeeze, and the math behind it points to a major price discovery phase that could redefine the market. First, let's summarize the mechanics. Retail and whales are simultaneously accumulating, removing coins from exchanges faster than they are replaced. Institutions are locking billions of dollars into ETFs and corporate balance sheets, creating a permanent drain. And on-chain usage is further absorbing liquidity, temporarily locking coins for operational purposes. The result? The available float on exchanges is at historic lows. Think of it as a pressure cooker. The liquid supply is the only way to release pressure. When it shrinks dramatically, any external buying demand must be absorbed by a smaller and smaller pool of available XRP. Even moderate buy orders can now push prices sharply higher simply because there are fewer coins to sell. This is how markets go vertical, not because of hype, but because supply has been systematically removed. The numbers are staggering. More than 570 million XRP withdrawn from exchanges, over $1.3 billion locked in institutional custody, and rising on-chain transaction volumes. The liquid supply versus total demand is now off balance by roughly 5 to 1. This is not a small imbalance. This is the kind of structural setup that historically precedes rapid price appreciation. From a technical perspective, the Elliott wave and Fibonacci models suggest that XRP is in the middle of wave 3, which is historically the strongest and most impulsive phase in a market cycle. During wave 3, liquidity shortages and increasing demand create steep upward price movement. Combine this with the supply squeeze, and the result is a near perfect storm for a vertical move toward the 1.618 Fibonacci extension, currently just below $6. Now there are still risks. Dormant legacy wallets, early XRP holders who have remained inactive for years, are beginning to stir. Even a small portion of their holdings hitting the market could temporarily offset the supply squeeze. But historical patterns show that such corrections are usually short-lived if the dual accumulation and institutional demand remain intact. The foundation of scarcity is simply too strong. The key lesson here is that price is no longer the leading indicator. Price reacts to liquidity, not speculation alone. By tracking supply outflows, accumulation trends, and institutional positioning, you can anticipate the market before the broader public even realizes a move is underway. This is exactly how professional crypto analysts operate, reading the hidden flows instead of chasing candles. Psychologically, the market is shifting too. Retail holders are now aligned with institutional buyers. The combined conviction across the spectrum creates a wall of no supply available for sale. This transforms what would normally be small price movements into structural, multi-week, or even multi-month rallies. Every token removed from exchanges increases the probability and velocity of upward price moves. To put it simply, we are seeing a blueprint for controlled scarcity. The institutions have created it, whales are supporting it, retail is following it, and the on-chain usage ensures it is functional and permanent. Once the remaining exchange float reaches critical lows, XRP's price discovery phase accelerates. Those who fail to understand these dynamics risk being left on the sidelines. Finally, this is why monitoring liquidity, outflows, and accumulation is essential. Traders who focus solely on charts or news are playing catch-up. Those who understand the structural forces driving supply and demand have a front-row seat to price discovery. In conclusion, the XRP market in 2026 is no longer just a speculative playground. It is a supply-driven, institutionally reinforced, operationally utilized ecosystem. The hidden drain beneath the surface has already occurred, and the stage is set. The next major price movement is inevitable, and the participants who recognize the mechanics now are the ones who will benefit the most when the market adjusts to reflect the true scarcity of XRP.